Welcome to csstudents.com, a learning portal for companies. The Companies Act 2013, or we say New Companies Act, was approved by Parliament in year 2013. Some of the sections of the New Companies Act came into force in September 2013. Many sections of the new Act came into effect from 1st of April 2014. Some of the provisions of the old Companies Act are still applicable. In this presentation we would discuss the conceptual changes and regulatory provisions relating to private placement of securities, brought by the Companies Act, 2000. Under the Companies Act, 1956, private placement of securities was the simplest exercise. However, the new Act provides numerous provisions to regulate the private placements of securities. For example, in the previous Act, the requirement of shareholders' resolution was limited to public companies. Under the new Act, all the requirements are similarly applicable to both private and public companies. Under the new Act, these new requirements are also extended to the issue of all kind of securities, viz. equity shares, preference shares or debentures, under private placement. Before we jump to the legal provisions of the private placement of securities, let's understand the term private placement. In the Companies Act, 1956, there was no word as private placement. However, in the terminology of business, private placement has been a known term. As we know, a company can raise funds by way of issue of securities such as shares and debentures. Any subscription of security is a contract under the Indian Contract Act. While issuing the securities, company makes an invitation to offer. Then people make an offer in the form of subscription. And then the company accepts the same by making the allotment of such securities. This invitation to offer could be made to public at large, or to select people or a group of people. Whenever offer is to be made to select people, it's known as private placement. Regulatory authorities always differentiate between the offer made to select people or general public. Previously, in the Companies Act, 1956, there was no term as private placement. But from business perspective, whenever an offer was made to only select people, conceptually it was called as private placement. For example, as appearing on the screen, if a company makes an invitation to offer only to X, Y, and Z, then it's a case of private placement. Or if such invitation is made to anyone, whomsoever is interested to subscribe to the securities, it's a public offer. From regulatory perspective also, there is a difference in public offer and private placement. The basic objective of SEBI or Corporate Affairs Ministry is to protect the public investors. Primarily, SEBI or Corporate Affairs Ministry want investors to make informed decisions while investing in the securities. So they regulate the public offers extensively by making disclosure requirements, appointment of issue managers, regulating all the intermediaries. However, these authorities may be less worried in case of private placements, because offer is made to select people and there is no public involvement. So private placements are less regulated. Same is also true in case of New Companies Act. But in comparison to the old Act, the new Act is more demanding. The New Companies Act provides a lot of requirements to be complied, even in case of private placement of securities. Regulatory provisions. Section 42 of the Companies Act, 2013 deals with the private placements. Ministry has also framed rules to regulate allotment of securities, of which Rule 14 is relevant for private placement. Definition of private placement. Explanation given in the subsection 2 of the Section 42 provides the definition of private placement. As per the explanation, private placement means any offer of securities or invitation to subscribe securities to a select group of persons by a company through issue of a private placement offer letter, and which satisfies the conditions specified in this section. So if we analyze the above definition, the basic element is offer or invitation to offer should be to select group of persons. Select group means to whom the company can identify at the time of making such invitation. But when we link private placement with invitation to a select group, whether the company is free to make offer to thousands or lakhs of people by addressing the offer by their names. As per the basic principle, if offer is made to 1,000 people, then there is no point calling this offer as private placement. Subsection 2 of Section 42 clearly provides that, under private placement, offer or invitation to offer could be made to persons not exceeding 50, or such higher number as may be prescribed by the government. Accordingly, the Ministry of Corporate Affairs have prescribed that private placement could be made to maximum 200 persons in a single financial year. Therefore, in case of private placement, offer or invitation to offer to the select group shall be restricted to maximum 200 persons in a single financial year. Therefore, even if offer is made to select group, but if made to more than 200 persons, then such offer shall become public offer, and will have to comply with stringent provisions under the. This ceiling of 200 persons is not applicable in case if offer or invitation is made to qualified institutional buyers, or we say QIBs. QIBs are defined in SEBI regulations, and the definition includes investors, like financial institutions, mutual funds, venture capital funds, banks and foreign institutional investors. So if the company is making private placement to any QIBs, it can make offer to more than 200 QIBs in a single financial year. The rationale of this exemption is, QIBs are generally bigger investors. They make investments after doing an extensive research. So regulator may not need to interfere much in such allotments to make offers as public offer. Therefore, the Act continued to classify QIB offers as private placement, even if such offer is made to more than 200 persons. The other exception is, if offer is made to employees under any employees' stock option scheme. Means company is free to make offer to more than 200 persons in a financial year. If such offer is made under any employees' stock option scheme. The other regulatory requirements. Section 42 of the Companies Act, 2013, stipulates the legal provisions for private placement. As discussed earlier, Ministry of Corporate Affairs has stipulated the company's prospectus and allotment of securities rules, 2014, in this regard. Rule 14 of those rules provides various procedural and other requirements for private placement. In this section of presentation, we shall deal the requirements under the Act and the rules. As per subsection 1 of Section 42, any company can make private placement of securities by issuing a private placement offer letter. As per Rule 14, the company will have to issue such offer letter in Form PAS4. Form PAS4 provides where these disclosure requirements are classified in 5 heads. The first head pertains to general information about the company, which includes name, address, information about the management, details of directors, business activity, risk factors, any previous defaults on statutory or legal dues, details of compliance officer, etc. The second head relates to the particulars of offer, for which letter is being issued. In this head, the company has to make disclosures about the dates of resolutions, kind of securities offered, price and total amount to be raised, terms of securities, time schedule, and purpose of the offer, etc. The third part relates to interest of directors, litigations, etc. The fourth part talks about the financial position of the company. And the fifth part relates to the declarations made by the directors about the compliances done relating to the offer made through the letter. All offer letters shall be accompanied by an application form and shall be serially numbered. Each offer letter shall be addressed to the person to whom the offer is being made. Such offer could be made in physical or in electronic form. The proviso of Sub-Rule 1 of Rule 14 puts a strict condition that no person, other than the person to whom offer is made, is entitled to subscribe the securities under the offer. As per Sub-Rule 2 of Rule 14, every private placement offer is to be approved by the shareholders by way of special resolution. This approval shall separately be taken for each offer or invitation made by the company. However, in case of issue of non-convertible debenture, the company can pass a single special resolution once in a year to cover all the offers and invitations to be made in that year. The proviso to Sub-Rule 2 also provides that the explanatory statement sent to the shareholders for such special resolution shall provide the justification of the price and premium on which such offer. Sub-Rule 2 of Rule 14 also provides that offer cannot be made to more than 200 persons in a year, exempting the cases of QIB and employee stock options. The Sub-Rule 2 also provides that the number of 200 persons for each financial year shall be separately taken for issue of equity shares, preference share, and debentures. Means, a company can have 3 separate private placement offers to 200 persons each, if security is different. So in a financial year, the company can offer its equity shares to not exceeding 200 persons. And in the same year, the company can offer its debentures to 200 persons as separate issue of securities. Now coming back to the remaining provisions of Section 42 and the rules. Subsection 3 of Section 42 provides that the company cannot make any fresh offer unless the allotment of previous offer has been completed, or such previous offer has been withdrawn or abandoned by the company. Sub-Rule 2 of Rule 14 provides further clarity over it. It says that the new offer of any kind of security shall not be made unless the securities in previous offer have been allotted, or such offer has been withdrawn or abandoned by the company. Means, for example, as appearing on the screen, if previous private placement offer of equity shares is not completed, or withdrawn, or abandoned, the company cannot make new offer of equity shares or preference shares, or debentures. Sub-Rule 2 of Rule 14 further provides that In the private placements, per person minimum subscription size shall be rupees 20,000 of the face value of securities. So, in any private placement, whatsoever is the size of the premium, the face value should be at least rupees 20,000 for single application. Subsection 5 of Section 42 provides that all the monies payable under the private placement shall be through check or DD or through other banking channel. Means, no cash payments for subscription of securities in private placements. Sub-Rule 2 of the Rule 14 further provides that the company will have to keep the records of the bank accounts from where the money has been received. Means, regulatory authorities such as tax department can anytime ask the company to give the details of the bank accounts where the money has been received from. On a practical note, the company can easily determine the subscriber's bank account details if payment is made through check or electronic bank transfer. However, in cases of demand drafts, the company should ask the subscriber to provide a confirmation letter from the banker that the demand draft of subscription amount has been prepared from so-and-so bank account. The Sub-Rule 2 of Rule 14 also provides that if two persons are jointly subscribing to the securities, the money should come from the bank account of the first holder. The time limit to complete the allotment under the private placement. Under the previous Companies Act, there was no time limit for allotment of securities under private placements. Companies used to keep the monies for years showing as share application money pending allotment. Companies were also free to use the monies for their business even without allotting securities. There was no end-use restriction. The new Companies Act curbs all those liberties. Subsection 6 of Section 42 provides that the company shall make the allotment of securities within 60 days of the receipt of subscription money. So the company cannot keep the subscription money for years without making allotment. The subsection 6 further provides that if the company is not able to make the allotment in 60 days, it has to refund the subscription money within 15 days of completion of such 60 days from receipt. And if money is not refunded within such 60 plus 15 days, the company will have to pay an interest rate of 12% per annum till the time money is refunded. The proviso to subsection 6 provides another restriction. As per this proviso, the company cannot use the subscription money until the allotment is done. So, although the company has 60 plus 15 days to refund the money, it cannot use that money for its business without the allotment. As per the proviso, all subscription monies shall be kept in the separate bank account and could only be used for the purpose of allotment of securities or for making refunds to the subscribers. So, in future, if your company is proposing to raise funds through private placement, do not forget to open a separate bank account to receive and keep the subscription money until allotment. Recording the names of the persons to whom offer is to be made. As discussed earlier, as per the definition. In case of private placement, offer, or invitation to offer, is made to select group of persons. As extension to that requirement, subsection 7 of section 42, puts the requirement of recording the names of the offerees, before making any such offer, or invitation to offer. As per subsection 7, the company is required to record the names of the persons, to whom such offer is made. Such recording should be prior to making such offer. As per sub-rule 3 of Rule 14, the company shall maintain such recording in the form, PAS 5. The company would also file complete offer information with the registrar within 30 days of circulation of such offer letter. Accordingly, the sub-rule 3 provides that the company would file the names recorded, along with the private placement offer letter, with the registrar. Such filings shall be done within 30 days of circulation of letter. Explanation to sub-rule 3 provides that the date of offer letter shall be construed the date of offer, for the purpose of filing. No advertisement for the offer. Subsection 8 of section 42 provides a clear restriction on the companies to put any public advertisement for offer or invitation, or to utilize any media, marketing or distribution channels, or agents to inform the public at large about such an offer. As per section 42(9), read with Rule 14(4). Any company which has done the allotment under the private placement shall file return of allotment in form PAS 3 with the registrar. Penalty. As per subsection 10 of section 42, if a company makes an offer or accepts monies in contravention of this section, the company, its promoters, and directors shall be liable for a penalty, which may extend to the amount involved in the offer or invitation, or 2 crore rupees, whichever is higher, and the company shall also refund all monies to subscribers within a period of 30 days of the order imposing the penalty. So the minimum penalty is rupees 2 crore. There should be the enough reason to have careful compliance of the private placement provisions. This is end of the presentation. For more study-related support, please visit csstudents.com.